Hello, welcome back. In this video, we're going to talk about revenue recognition. So this is Intermediate Accounting Chapter 6, and it is super important as accountants for us to understand when to recognize revenue and for how much. So there's going to be a lot to this chapter. It seems like such an easy concept. Okay, we recognize revenue when we get money or when we provide a service, but there's a lot of details that we need to consider. So that's what we're going to talk about in this video. So, first of all, what is revenue? It is the total amount of money a company earns from its normal business activities, such as selling goods or providing services, before any expenses are deducted. Remember, revenue is that top number, and then we're going to subtract out any cost of goods sold and all of the operating expenses after that. But we want to show revenue as that top number, and we show it under accrual accounting when it is earned when we provide the goods or services. So the important question is when to recognize revenue and for how much. So we are going to start with the different steps, and then throughout these videos, we are going to go through the steps. So first, we're going to start with identify the contract with a customer. So this is where we are going to establish that an agreement exists and it meets specific criteria. That is the first step. We establish that agreement. So we are going to look at some examples for each of these steps, and that will be our step one. Then we want to identify performance obligations. So we determine what goods or services are promised and whether they are distinct. So is it that a customer walks up to the register and they say, I want to buy this pair of shoes? Or is it that there's a construction contract that we have this whole agreement and we have to make sure we make it very clear what we are supposed to deliver as the contractors to the customer? So that can get pretty complicated depending on what it is. Third, we want to identify the performance obligations. We are going to focus a lot on step 3. So we won't look at that until a separate video, but there are a lot of things to consider with step 3. We want to figure out the amount of consideration the company expects to receive in exchange for transferring goods or services. And it can be super straightforward and easy, or it can get really complicated. Our step 4 will be to allocate the transaction price. So we distribute the transaction price to each performance obligation. So if there's multiple performance obligations, it's not just buying a pair of shoes, then we want to base it on relative standalone selling price for each one of those. Then we want to recognize revenue when, or if it's over time, as the entity satisfies a performance obligation. So that's when revenue is recognized when control of the good or service is transferred to the customer. It may be at one point in time or it may be over a period of time. So we're going to see lots of examples of all of these. So let's start with when to recognize revenue if we're looking at a single point in time. So we have a customer that likely has control of a good or service if they have an obligation to pay the seller. So if you've already provided, that's probably when they have the transfer to them. They have legal title to the asset. They have physical possession. They have assumed the risks and rewards of ownership, and they have accepted the asset. So again, if we go back to buying a pair of shoes, I really like shoes, y'all. Can you tell? If we go to buying a pair of shoes, it's very clear when that transfers over from the seller to the buyer. They're going to have that physical possession. It's going to be their job to take care of the shoes at that point. Again, very clear cut, but there could be other circumstances that make it a little shadier, a little more gray area. So we need to make sure we understand the steps to recognize this revenue. So let's look at Sunset Sound Systems. Okay, when I created this example, I did not realize how hard that was going to be to say. That's quite a tongue twister. Sally sells seashells by the seashore. I'm kind of feeling like that. So Sunset Sound Systems sells and installs high-end audio equipment. On May 1st, they sign a contract to sell a customer's speaker system to a concert venue for $25,000. So they made the agreement on May 1st. The system is to be delivered and installed on May 20th, at which point the ownership and control will transfer to the customer. Credit terms allow for payment in 30 days. Okay, so if we're going to break down this word problem, what is it telling us? Payment is due in full upon delivery and installation. Okay, and the customer cannot use or benefit from the equipment until the installation is complete. And Sunset retains control of the system until it's fully installed. So, and whenever it says payment is due in full upon delivery and installation, it does tell us they have 30 days, but it's going to be 30 days from when they deliver and install it. So those are important things that we know. So they made the contract on May 1st, they're delivering it May 20th, and then they have up to 30 days to pay for it. So on which date would Sunset Sound Systems recognize revenue and why? So there's our same information, nothing changed there, but we know that they're going to recognize it not on May 1st when they made the agreement, but on May 20th when Sunset Sound Systems, when they delivered and installed. And there's been no payment happen before that. There's been no delivery of goods or services. So it's not until May 20th that they would actually recognize revenue. So we wouldn't actually have to record anything on May 1st as far as financially in the accounting records. So we would wait until May 20th. They gain control and use only after that installation. So that's when revenue is recognized at that point in time. And it's not over time because it all happened at once that they did it. Same information here, but here's the entry that is to be made on May 1st. Nothing. I feel like no entry is obviously like the easiest. You're like, sweet, I don't have to make an entry. But at the same time, it's like, well, sometimes it's the hardest for students to get to because they're trying everything and it's wrong and it's wrong and it's wrong when it was really just no entry at all. So no entry on May 1st. We don't have to put anything in our accounting records on May 1st because it's just an agreement. Yeah, there's going to be some paperwork there, but it's not going to be put into the accounting records. May 20th, however, if you want to pause the video and try to make this entry yourself, then feel free. But I'm going to go ahead and show it to you. We are going to, on May 20th, we get to go ahead and show that revenue. And we know that we're debiting accounts receivable because of the last line, credit terms allow for payment in 30 days. So we debit accounts receivable, we credit sales revenue for the full $25,000 because it was a single point in time. All right, so we'll keep moving along here. So whenever the customer actually goes and pays Sunset Sound Systems, what entry are they going to make at that point? This is a really basic one that we've covered a lot. If you want to pause and try to make it yourself, then go for it. But I'm going to go ahead and show it here in 3, 2, 1. So once they go ahead and pay it, then Sunset Sound Systems is going to get rid of that accounts receivable by crediting that asset, and they'll be debiting cash for the $25,000 once they pay within that 30 days of their credit terms. Did you get that one right? All right, so that was a one period of time, a set period that they went ahead and recognized all the revenue. But sometimes it's over a period of time. It's not just a single time. So let's look at how that would affect the financial statements. So revenue is recognized over a period of time if any of the following 3 criteria are met. It's nice when they give you criteria like this because then you're able to really check off and see if it meets these criteria. So the customer consumes the benefit of the seller's work as it is performed. Okay, so it's not that the customer, like in the last one, they get all the benefit at once. This is where the customer is going to get the benefit over time. The customer controls the asset as it is created. So we're not just creating a table for our customer and then delivering it at once. They're getting use of it over time as we create it. The seller's creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payment for progress to date. Okay, so this is a little bit different. This is where, let's say the customer has ordered a specially made table. And this table is not just any other table that you could sell to some other random family. This is a family of 17, and they have ordered a table with their names engraved at each spot because they're very, very serious about not fighting over a seat at the dinner table. So you are making this table for them with 17 spots, which is already tricky because it's an odd number. That'd be a weird table. And you are also going to be engraving their name at each spot as the seller. So the buyer has to pay you whether they want to or not at the end of it. They have the legal right to have to pay you because it is specially made, and you wouldn't be able to sell a table seating 17 people with your family's names on it to anyone else. So let's look at Sunset Sound Systems again. So they offer a premium audio subscription service called Sunset Studio Plus, where customers get monthly access to exclusive content, downloadable sounds, and technical support for mixing equipment. On July 1st, a customer signs a 1-year subscription contract and pays $1,200 upfront for the full year. The service is delivered evenly over a 12-month term. Made the numbers nice and easy for us here. So this is not one point in time. This is something that the buyer is going to consume over 12 months. They are going to get the benefit for it over the 12 months, not just at one set time. So how much should, I'm getting tongue twisted before I even start saying the name, how much revenue should Sunset Sound Systems recognize as of the end of the year? So this happened. This is really important. When you're doing accounting problems, look at all of the dates. Don't just assume January 1st and December 31st. This started on July 1st. Okay, so we're 6 months in. And then they want to know how much will be recognized December 31st. So we're going to take the $1,200 divided by 12 months. So that's going to give us $100 a month, right? Made it really easy for you. July 1st to December 31st is 6 months. So we take the $100 a month times the 6 months, and it would be $600 we'd be recognizing. Now, this is assuming they didn't recognize it each month. You know, some companies are going to recognize it each month. A lot of times we see in our accounting homework where they just account for it at the end of the year. So if they did it each month, they'd be recognizing that revenue $100 a month. If they waited till year end, they would do 6 months worth all at the end because of July 1st through December 31st. Okay, so we know all that information, and we want to look and see what the journal entry would be. So the journal entry, assuming this started July 1st and we didn't record any revenue until December 31st. We just wanted to wait until the end of the fiscal year. So we would show, first of all, on July 1st, the cash coming in. We have to show the cash coming in even if we haven't done anything for it yet. So cash comes in at $1,200, and then it's a liability of unearned revenue. So we credit the liability unearned revenue. Unearned revenue is a little tricky because it's not a revenue account. It's not an equity account. It is a liability. It is showing that we owe someone something. Then on December 31st, we get to show $600 worth of the revenue. No cash is being exchanged on December 31st. So that's important to remember. But since we're using accrual accounting, we didn't show all the revenue whenever we got the cash. No, instead, on December 31st, we are going to get rid of that portion, which happens to be half of the unearned revenue, the liability, and we get to actually show that as we did the work as Sunset Sound Systems. We did the work. We have earned that $600. The other half, the other $600, we will show. I guess they're going to show it at January 30th once the contract's up, or they could show it monthly if they had chosen to do it that way. All right. So if a performance obligation does not meet any of those 3 criteria for recognizing revenue over time, the revenue would be recognized at just one point in time. So when it is fully satisfied. So that would typically be at the end of the contract. So let's see if there are multiple performance obligations and how that would affect it. So if a contract included more than one performance obligation, you'll need to pay close attention to step 2 identifying performance obligations, and step 4, how we allocate the transaction price. So it may be two separate performance obligations, and we recognize them differently. So we're going to work through an example with that here in just a minute. So we're on step 2 here, identify the performance obligations. We'll see if there are separate or if there's just one performance obligation. The seller accounts for a promise to provide goods or service as performance obligation if the good or service is distinct from other goods or services in the contract. So we're able to break it into separate performance obligations, then that means there'd be more than one. So it'd have to be capable of being distinct. Okay, I see that there's this aspect to it and this aspect, and we can separately identify them from each other. So if this is really confusing to you, don't worry. We're about to do an example with our company, and it will help us to walk through what this actually means. So back to Sunset Sound Systems. So we know that they offer equipment, and we also know they offer a subscription, but now they decided, for maybe marketing talked to them and said, why don't you sell a bundle package? So they call it the Sunset Starter Kit for $1,500. The package includes audio equipment that would typically be $1,200 by itself, and a 1-year subscription to Sunset Studio Plus. So that standalone price would be $600. So together, they're getting $1,800 bundle, but a value, but they're only having to pay $1,500. So the customer pays the full $1,500 up front on August 1st, 2025. So this is our first customer to agree to this bundle package. Maybe we should have given our customer a name. So what should we name him? Let's name him Alfred. Okay, so Alfred pays $1,500 up front on August 1st, 2025. The equipment is delivered immediately. The subscription begins August 1st and provides service evenly over 12 months. So you can see right there, sneak peek, there's multiple performance obligations, right? We've got the equipment, and then we've got the subscription that's going to last for 12 months. And we already know the standalone price, so that's going to help us as well. So let's talk about how this is going to be accounted for. We've got those two different performance obligations broken out into two different distinct performances that we're going to do here. So we have delivery of the audio equipment that's going to happen right there on August 1st to Alfred. And then Alfred still gets to use 1 year of the subscription. So here's how we could break it out. The equipment would have been $1,200 by itself. Subscription would have been $600. So as I already mentioned, that's a total of $1,800 value. For an $1,800 value, you can have a bundle price of $1,500. So what we're going to do, we need to figure out what percentage are each of these obligations to the total. So we take the $1,200 for the equipment, divide it by the total, the $1,800, and that tells us it's 67% of the total the equipment is. Then we take the $600 subscription divided by the $1,800, and that tells us that 33% is the subscription. So then we are going to take the $1,500 bundle amount, and we'll take $1,500 times the 67% or 66.7, and that gives us $1,000. Then we take the $1,500 times the 33%, that gives us $500. So this is how we're going to break it out. Even though on their own, the equipment would be $1,200 and the subscription would be $600, we did not get $1,800 from this. Instead, we got $1,500, so we need to figure out what percentage each of these separate performance obligations make up of the total, and then we multiply that times the bundle amount, the $1,500, to get the allocated price. Please remember this. I see all the time where students, we talk about this, but then they go in and they still do the full price, and then they show cash coming in of $1,500. It's like, well, where's the $300 difference? And they'll make up some kind of discount account. No, you need to just show at this price, because technically we're selling them at those allocated prices. So when they actually record the entry on August 1st, they're going to show cash coming in of $1,500. They get to go ahead and show $1,000 of sales revenue. because they delivered the equipment. That performance obligation is done. We've done what we have to do. The subscription, however, that $500 will cover the 12 months. So we're going to take the $500 and put it in unearned revenue. Sunset Sound Systems has not provided the Studio Plus subscription. I've got to get rid of all these S's. They haven't delivered them. They haven't given him anything yet to Alfred on August 1st. So right now, all of that $500 allocated price to the subscription is unearned revenue. It's a liability. SSS owes Alfred the 12 months. So last slide we'll look at in this video, and then you can jump to the next video that continues on with more about recognizing revenue. So the 5 months, we take the $500 divided by 12 months would be $41.67 a month. So if we didn't recognize it monthly and we waited till the end of the year, we would show 5 months times $41.67. That was from August 1st to December 31st, 5 months. And that gives us $208.35. So on December 31st, if they haven't recognized any subscription revenue for providing Alfred with the Studio Plus service, we now take that $208.35 out of unearned revenue, out of that liability by debiting it, and we don't show any cash. Cash all happened on August 1st, but then we get to show that we earn the service revenue of $208.35. All right, make sure you stay tuned for the next video because unfortunately things get more complicated.